It's Sunday night. You're on the couch, half watching something you don't even like, and you do that responsible adult thing. You open your 401k app. You see a number. Maybe it's bigger than last year. Maybe it's smaller. Maybe it's basically flat, and you tell yourself, the market's been weird. Then you tap investments, and it hits you. You're not even sure what you're looking at. Target Retirement 2045, large cap growth, balanced fund, stable, value. A few ticker-like codes that might as well be licensed. And here's the quiet fear that almost nobody says out. What if I've been doing this for 10, 15, 20 years, and I don't actually know what I own? Not generally, not kind of. I mean literally. What businesses, what bonds, what risks, and what it's costing you to hold them. Because that's the part that stings. When you don't know what you own, you usually pay for it. Sometimes you pay with fees you never noticed. Sometimes you pay with false diversification. Sometimes you pay with the worst possible timing, because panic always charges the highest price right when you can least afford it. And yes, there is usually one line on your 401k statement that tells you more than you think it does. A line most people skim right past. In a few minutes, I'll tell you exactly what to look for, so you can stop funding your retirement on blind faith. But first, I want to say something that might sound harsh, and I mean it as protection, not as judgment. A 401k can be one of the greatest wealth-building tools ever created for ordinary workers, or it can become a very expensive illusion of progress. Same paycheck, same contributions, same responsible behavior, completely different outcome. Benjamin Graham, the father of value investing, had a definition that still cuts through all the noise. He said, in essence, that an investment operation is one that, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. Most 401k investors don't think they're speculating. But if you don't know what you own, what you're paying, and whether the risk matches your real life, you're not investing. You're outsourcing your future to a menu. So here's what we're going to do together, Graham style, in a way that respects the reality of middle-class life. No spreadsheets that require an MBA. No market predictions. No, this one weird trick. Just a 15-minute audit built around three questions. Three questions that put you ahead of the majority of 401k participants immediately. Question 1, what do I actually own? Question 2, what am I paying? Question 3, is my risk appropriate for my real life? If you can answer those three, you're no longer guessing. You're no longer just hoping. You're managing. And you'll also know something else. By the end, whether your 401k is on track without turning retirement into a daily anxiety ritual. Now, before we dive in, a quick reality check that will make the thumbnail make sense. When you log into your 401k, you don't own those funds the way you own a house, or even the way you own a single stock in a brokerage account. Your plan's assets are typically held in a trust structure for participants, and you have a beneficial claim. Practically speaking, you do have rights to that money, but you don't control what's inside each fund. You don't vote on what it holds, and you don't decide how it's managed, and that's fine. Pooled funds are not the enemy. The danger is that the label starts to feel like ownership. I own a 2045 fund. No, you own a slice of a vehicle that owns things on your behalf. And if you don't understand the vehicle, you don't understand the ride. That's what you don't own it really means. You don't own understanding by default. You have to earn it. And the good news is, earning it is simpler than most people think. So pull up your plan portal or grab your latest statement. Don't change anything, just observe. Let's start. What do I actually own? Most people answer the vibe. I'm in a target date fund, so I'm diversified. I picked a growth fund because I'm young. I picked a bond fund because I'm conservative. Graham would call that what it is, a story, not an analysis. Here's the simplest way to turn your story into facts. Look at your top 1 to 3 holdings, the funds that hold most of your balance, not the little 2% side fund you forgot you even selected years ago. The big ones. Now click into each fund and find one of these sections: holdings, portfolio, composition, or fact sheet. You're looking for 3 things. What asset classes does this fund actually hold? What style is it? Growth, value, blend, large, mid, small, US, international, and how concentrated is it? Let me give you the 60-second test I promised. Open the fund and find top holdings. If the top 10 holdings are basically the same names you see everywhere, Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and your other funds also have the same names in their top 10, you're not as diversified as you think. You might have 5 funds, but you may have one bet, repeated 5 times. This is the most common diversification illusion inside 401ks. Someone selects an S&P 500 fund, then adds a large cap growth fund, then adds a blue chip fund, then adds a dividend fund, and psychologically it feels prudent because there are multiple choices. But economically, it can be the same exposure with different packaging. Graham didn't demand complexity, he demanded clarity. If you want to be a defensive investor, the kind Graham wrote for, the ordinary person with a real job and a real life, your edge isn't brilliance. It's avoiding big mistakes. And one big mistake is thinking you spread risk when you actually just multiplied it. Now let's talk about the most common holding in America's 401ks, the target date fund. Target date funds can be perfectly reasonable, but most people don't know what they are. A target date fund is usually a fund of funds. Inside it are stock funds and bond funds, and it follows a glide path that slowly shifts more conservative as the target year approaches. Here's what you must check. What is the stock to bond allocation today? Because 2045 doesn't tell you what you own right now. 2 different 2045 funds from 2 different providers can have meaningfully different risk profiles. One might be 90% stocks, another might be 85%. One might have more international, another might have more US growth. One might include real assets, another might not. And near retirement, those differences matter. So click Asset Allocation or Portfolio Mix. If you're 55 and your retirement fund is still heavily aggressive, that might be fine, if your life can absorb it. If you're 55 and you thought you were conservative because you chose a retirement fund, but it's still mostly equity risk, then you're taking risk you didn't consciously choose. And Graham would say, unchosen risk is the kind that destroys people. Now, a quick word about bonds, because bond funds are where a lot of 401k confusion hides. People think bond means safe, but bond funds can be risky in different ways. Interest rate risk. Long duration funds can fall hard when rates rise. Credit risk. High yield or lower quality bonds behave more like stocks in bad times. And inflation risk. A safe bond can still lose purchasing power. You don't have to become a bond expert, but you do need to know whether your bond fund is a short or intermediate high-quality core fund, or a riskier version wearing a calm name. Again, clarity. Now, there's one more what do I own issue that can be downright dangerous in workplace plans, company stock. If your plan offers your employer's stock and you have a large chunk there, pause. I'm not saying your company is bad. I'm saying your risk is doubled. Your paycheck depends on the company. Your retirement depends on the same company. That's not margin of safety. That's concentration. Graham was obsessed with avoiding single-point failure. A retirement plan should not be a fragile bridge. It should be an overbuilt one. So that's question one. Do you know what you actually own? Not the fund name, the exposures. Now question two, the one most people feel in their gut once they see it. What am I paying? The market will take its share. You can't control that. Fees are different. Fees are a choice, sometimes made for you by the plan menu, but still a choice to accept or to correct. And fees are sneaky because they don't show up like a bill. They don't email you, hey, we just withdrew $38 from your account today. They simply lower your return every day quietly, like a small hole in a bucket you're trying to fill for 30 years. Start with the obvious fee, the expense ratio. In the fund's fact sheet, look for gross expense ratio or net expense ratio. If you see 0.80%, 0.95%, 1.10%, I want you to feel what that means in real life. Let's use a clean example with simple assumption. Imagine you contribute $500 a month for 30 years. If your money earns an average 7% a year before fees, that stream of contributions could grow to roughly about $610,000. Now shave off 0.75% per year in higher fund costs, so you earn 6.25% instead of 7%. That same discipline, same $500 a month, same 30 years, becomes roughly about $527,000. That's around an $80,000 difference, created without a crash, without a recession, without you doing anything wrong, just fees. And that's only one contribution scenario. Many people contribute more than $500 a month. Many go longer than 30 years. The gap can become six figures quietly. This is why Graham's margin of safety isn't just about buying cheap stocks. It's about stacking the odds in your favor wherever you can. Lowering unnecessary friction is margin of safety. Now, here's the part I told you I'd reveal, the line most people miss. Because in many 401ks, the fund expense ratio is only part of the cost. Plans can also have administrative fees, record-keeping fees, advisory fees, and various service fees. Sometimes your employer pays some of these, sometimes participants pay them. Sometimes they're fixed dollar amounts. Sometimes they're a percentage. Where do you find them? On your statement. Look for anything like plan administrative fee, record-keeping fee, service fee, advisor fee, or sometimes it's tucked under other withdrawals or plan expenses. The names vary by provider, but the idea is the same. If you don't see it clearly, check the plan's fee disclosure documents. Often required disclosures are available in your portal. The language can be dry, but you're only hunting one thing, total plan level cost to you. Here's the key mindset shift. A plan can offer a low-cost index fund and still be expensive overall if the plan level fees are high. Or a plan can have moderate fund costs but low plan fee. You're not hunting a villain. You're hunting reality. Because once you see your total cost, you can make rational choice. Maybe switch from a high-cost, actively managed fund to a low-cost index option. If your plan offers one, maybe avoid managed account services that charge an extra layer unless you truly need it. Maybe ask HR politely, firmly, whether the plan has lower cost share classes available or whether a cheaper provider is being considered in future renewals. Most people never ask. And because most people never ask, nothing changes. Graham's students didn't win by being loud. They won by being rational when others were passive. Now let's do the quick gut check on fees without getting lost in decimals. If your plan has broadly diversified index options with very low expense ratios, and you're not paying a bunch of extra advisory layers, you're probably fine. If your core funds are all above, say, the range where low-cost options exist, and you're also seeing plan fees, you're paying more than you need to, and every unnecessary fee is a guaranteed negative return. Not maybe, guaranteed. Now, question 3 is where Graham stops being an investing author and starts feeling like a life coach for the financially serious. Is my risk appropriate for my real life? This is where the 401k conversation becomes deeply personal, because risk tolerance isn't a personality quiz. It's math plus human behavior. If you're 27, no kids, stable job, and you can keep contributing through a recession, your ability to take risk is high. If you're 57 with a mortgage, maybe helping family, maybe dealing with health costs, maybe your job industry is unstable, your ability to take risk might be lower, even if your willingness is high. And the single most misunderstood retirement risk is not the market goes down. It's that the market goes down at the wrong time for you. This is what people mean when they talk about sequence of returns risk. If a major drawdown hits near retirement, you're forced to sell because you lose a job, because you need to withdraw, because fear finally breaks you. You lock in losses you never planned for. Graham's margin of safety here is not about predicting crashes. It's about not being fragile. So how do you check whether your risk makes sense? Start with a blunt question. If my 401k dropped 35% this year, would I still contribute next month? Most people want to say yes, but your past behavior and real stress, the truth. If you lived through 2008 as an adult, you know what it feels like when the world is screaming, everything is broken. If you lived through 2020, you know what it feels like when headlines make the future feel foggy. So be honest, because honesty is protective. Then look at your current stock and bond mix. If you're far from retirement, being mostly in equities can be reasonable. If you're close to retirement, having some defensive allocation can be the difference between staying calm and making a catastrophic decision. And this is where a lot of ordinary workers get trapped. They are aggressive because they never looked, or they are overly conservative because they got scared once. Neither strategy. Both are reaction. Graham would prefer a plan you can stick with over a plan that looks perfect on paper but collapses under pressure. So here's a simple framework that many defensive investors can live with. You want growth assets for the long run because inflation is real and retirement can last decades. You want defensive assets because you are not a robot and life does not send you bills on a convenient schedule. And you want an emergency cushion outside the 401k so you don't turn a market drop into a forced withdrawal. That last part is huge. If you have no cash cushion and life happens, car repairs, medical bills, job loss, the market becomes your emergency fund. And that is the opposite of margin of safety. Now, I'm not telling you to keep mountains of cash forever. I'm telling you to stop building a retirement plan that assumes nothing ever goes wrong, because something always goes wrong. Now we're ready for the question that's really behind the whole video. Am I on track? You want a simple answer because you have a job, a commute, responsibilities, and you don't want your life to be a constant retirement spreadsheet. Here's the Graham-style truth. Being on track is less about hitting a magical return number and more about controlling what you can control consistently. Your savings rate, your costs, your diversification, your behavior. So instead of asking, will the market give me what I need? Ask, am I building a process that doesn't require the market to be generous? That's the mindset shift that takes you from hope to strategy. Let's translate that into something practical. First, are you capturing the full employer match? If your employer offers a match and you're not getting it, you're leaving guaranteed return on the table. That is the closest thing to a free margin of safety most workers will ever see. Second, what is your total contribution rate? Not just you put in, you plus the match. A lot of retirement planning guidance in the U.S. clusters around the idea that saving in the neighborhood of 10% to 15% of income over a long working career tends to create a reasonable chance of a stable retirement for many people, depending on lifestyle, pension, Social Security expectations, health costs, and timing. That's not a law. It's not a promise. It's an anchor. If you're well below that and starting late, the math usually demands either higher savings, later retirement, or lower spending. And this is the part most people avoid because it feels like judgment, but it's actually empowerment. If you're afraid of arriving at 65 with almost nothing, the biggest lever is rarely finding a better fund. It's increasing the contribution rate in a way you can sustain, even 1% at a time. If you can't jump from 6% to 15%, don't jump from 6% to 7%. Then set an automatic increase of 1% every year or every time you get a raise. Make your future richer without forcing your present to feel punished. That's how ordinary workers win, not by one heroic decision, but by a system that quietly compounds. Third, are you chasing performance inside your 401k? This is where Mr. Market walks into your workplace plan. Graham's famous character, Mr. Market, shows up every day offering to buy from you or sell to you at emotional prices. Some days he's euphoric. Some days he's depressed. And Graham's advice is basically, don't let him set your mood or your plan. In a 401k, chasing performance looks like this. A fund does well for 3 years, so you move money into it. Then the cycle turns, then you move again. Then you freeze when losses hit. Then you wait for things to feel safe, which usually means you buy back higher. That pattern doesn't require low intelligence, requires being human. So the defensive investor builds rules to protect himself from being human at the worst times. A simple Graham consistent rule. Pick a diversified allocation you can live with. Contribute steadily. Rebalance occasionally. Ignore the noise. That's boring. And boring is a feature, not a bug, when the goal is retirement. Now, I want to bring everything back to the exact moment we started with. You on the couch. Sunday night. The app open, the numbers staring at you. Here's what changes. When you actually do this audit, you stop reading fund names as if they're answers. You see through the label. You can say, in plain English, this is mostly U.S. large-cap growth exposure. This is a total market index with broad diversification. This target date fund is currently X% stocks and Y% bonds. My bonds are mostly intermediate, high quality, not junk. My fees are low enough that I'm not bleeding out in silence. My plan level fees are visible, and I understand them. My risk matches my actual life. not my fantasy life. And most importantly, you stop fearing 65 because your plan becomes something you can explain, not to impress someone, to protect yourself. Because the fear most middle-class workers carry isn't really the market. It's the feeling that you're doing everything you were told to do, and it still might not work. Graham's philosophy was never about being fearless. It was about being prepared. Margin of safety is not a spreadsheet term. It's emotional insurance. It's the difference between "I hope this works" and "I built this to survive." So here's what I want you to do after this video. Today, not someday. Open your 401k and answer the 3 questions. What do I actually own? What am I paying? Is my risk appropriate for my real life? If you can't answer one, don't feel guilty. Feel alerted, because now you know what to fix. And if you want a simple final checkpoint, this is it. A good 401k plan for an ordinary worker is not the one that looks smartest. It's the one that stays intact through stress. It's the one you can stick with when headlines get ugly. It's the one that doesn't demand perfect timing. It's the one that doesn't quietly siphon pounding through avoidable costs. It's the one built like an over-engineered bridge. It's Benjamin Graham in retirement form. Not flashy, not trendy, not dependent on being right about next year. Just disciplined, defensive, and quietly powerful. And when you open that app next Sunday night, the number will still move up and down. But you won't feel that hollow uncertainty, because you'll finally know what you own, and you'll stop paying for what you don't understand.